And circle the wagons actually is a term that comes from the 19th century. And we had these large wagon trails going west, claiming land and conquering the frontier, if you will. And when the Native Americans attacked, the best defensive posture was to put the wagons in a circle and then try to defend as best as you can with that configuration. And I thought that that analogy might be a good way to think about investing in terms of circling the wagons. So I'll just go through a few slides and then we'll go through what you guys want to talk about. So this year in Buffett's letter, he had a couple of very candid and great quotes. He said, over the years I've made many mistakes and our extensive collection of businesses consists of a few enterprises that have truly extraordinary economics, many that enjoy very good economic characteristics, and a large group that are marginal. So actually if you look at the 80 plus acquisitions that Berkshire has done, Warren and Charlie probably themselves would acknowledge that probably at least half are outright mistakes. And this is, the best practitioners of the art. And then he goes on to say, in 58 years of Berkshire management, most of my capital allocation decisions have been no better than so-so. And our satisfactory results have been the product of about a dozen truly great decisions, and which he's saying is about once every 5 years. So I tried to basically look at this period from like 65 to 22. And so, you have, let's say, 80 acquisitions in this 58-year period. He probably bought at least 210 stocks. I use 210 for my convenience, so I get to a round number. I like to work with round numbers, but it's probably a larger number than 210. And his key hires, I'm expecting that in the last 58 years, he had at least 10 key hires, which were very important to Berkshire. So if you look at these decisions, there's about 300 important decisions. And he's saying that 12 move the needle. And so basically it ends up being something like 4%. And we have 4% from the gods of investing, which is doesn't give us a lot of confidence. And I took a stab at what the 12 businesses might be, or the 12 decisions might be. One of them we know is Ajit. So we put his picture up there. Because they've always pointed out that the single best decision they made was the search fee they paid to hire Ajit Jain. And there's a guy who used to, I think theoretically still works at Berkshire, Michael Goldberg. And Michael Goldberg, I think now must be in his 80s. And Michael Goldberg was the guy who hired Ajit. And he hasn't really been active in Berkshire for probably more than 20 years. So Warren's kept him on the payroll. And every year he gets $1 million from Berkshire. And if he lived till 150, they would keep paying him the million because it's still a great deal. So if you look at the other candidates, Geico is probably one of those, and then Coke, Amex, Seas, Apple, BNSF, Mid-American, National Indemnity, Gillette, Washington Post, and then Cap Cities, ABC. I think it might be that one or two of these might be off, and Warren or Charlie might say, well, you got maybe 90% or 80%, but most of it are directionally correct. That these were the large or the most important decisions that happened over almost 60 years. And what was really important, if you go back to these decisions, the important thing was not that they bought these 12 or they hired Ajit. The important thing was they kept them all. So it wasn't the buy that was, because they had, 288 mediocre to poor decisions. They kept those two, right? So basically, in effect, they kept all 300. They lived with all 300 decisions. And it was really important for these 12 not to have been deleted or sold. So basically, when we look at this kind of statistic, what we find is that investing is a very forgiving business. But it is forgiving if you don't cut the flowers and you don't water the weeds. So the difficulty comes when you start cutting flowers and watering weeds. But we see this pattern. So when we go and look at his record, with just a dozen decisions, it's just he's completely trounced the S&P. So even with this 4% great decisions, they are at almost 4 million % in annual returns. And basically the S&P is just a very small fraction of that. And I want to go over a few other examples because I want to show that it wasn't that Warren and Charlie were anomalies here. I think Warren and Charlie are more kind of par for the course in terms of how things work. So many of you may be familiar, there's a South African company called Naspers, and Naspers used to be a newspaper publisher. And they've been around for about 100 years. And in 1999 or 1998, they brought in a hired gun CEO, Koos Becker. And when they brought in Koos Becker, basically at that time, Naspers had a $500 million market cap. And Koos in 2001 took $32 million of that and bought an obscure Chinese company called Tencent. And he got a 46% stake, 46.5% stake in Tencent for the $32 million. And in fact, interestingly, they bought the stake from Li Ka-shing, who was a billionaire in Hong Kong, who was a very savvy investor. So it actually was a private transaction with Li Ka-shing selling, who's probably kicking himself for selling. And if we look at what happened, so Naspers has a $500 million market value. In 2004, when Tencent went public, the value of Tencent was about $900 million at the IPO. And so the Naspers share was almost north of 400 million, which would have been most of the value of the company. The company was about 500 million. It was now approaching half the value. They sold a little bit of a few shares at the IPO, but they pretty much did nothing after that. So from 2004 to 2018, they never sold a single share of Tencent. And if you look at it in 2018, Tencent has a market cap of 530 billion. So it went from 900 million, 10 billion, 50 billion, 100 billion, and they're not touching it. At this point, when Tencent is a $100 billion market cap, it's 99% of the value of Naspers is sitting in Tencent. It's basically almost the whole thing. And it's sitting in a company that they do not control. And it's sitting in a company that is in China. And through all of that, Koos Becker doesn't sell. And amazingly, the family, because he's not from the family, the family with the hired gun lets the hired gun do what he wants. And I just want to give you a story about Koos Becker when he was being hired. So he told the family, I do not want a salary. Please make my salary zero. I also don't want any bonus. Please make my bonus zero. And he said, all I want is whatever value creation occurs on my watch, just 6% of that comes to me. And the family said, where do we sign? Right? And so it was a great win-win for both sides, right? I mean, everybody won. And to their credit, even when it got to 100 billion or 200 billion of Tencent market cap, they sat there. And I think the reason they had the comfort to sit there was that Koos Becker was on the board. And he had a chance to spend a lot of time with Pony Ma, the founder of Tencent, who is a very unusual, probably one of the best entrepreneurs we've ever had in the history of entrepreneurship. So they kept, anyway, so even in 2018, when it was a $170 billion value, and they started to, in 2018, to close the gap between the Naspers NAV and the look-through value, they started to sell. But even today, basically, they've, for the most part, held the position. And it's a 50% compounded over 20 plus years. And again, the important thing was not that they invested in Tencent. because they invested in many other things. The important thing was that they didn't touch it. And even today, in 2023, Naspers is the largest shareholder of Tencent. And on a per share basis, so if you look at each Naspers or Prosus share, their look-through ownership of Tencent has only gone up. So even as they sold, the look-through ownership per share has gone up because they've done buybacks. And again, the circling the wagons around Tencent was really key. Then we have Rakesh Jhunjhunwala from India. Some of you may know him. And he passed away last year, unfortunately. He was only 62. And Rakesh was an exceptional investor, but he never managed money for others. He only managed money for his own account. And until maybe a year or two before his death, he really never started any businesses. So it was all the wealth was created organically from his investing. And he started with $400 when he was 25 years old. And when he passed away, it was $5.8 billion, and which was a tremendous, 56% compounded over 37 years. In 2003, Rakesh bought 5.9% of a company in India called Titan Industries, which has a brand called Tanishq. And Tanishq is basically a jewelry and fashion retailer. So he owned 5.9%. And then by 2011, he had increased his stake in Titan to 11%. The second 6% or so that he bought, or 5% that he bought, he paid almost 20 times what he paid for the first 6%, which is psychologically really hard for us to do. We investors get to anchoring. I bought something at $10. I'm not going to pay $200 for the same thing. But he amazingly kept adding to his Titan position at higher and higher prices. And basically, that's very difficult to do psychologically. And when he passed away, so he sold some as he went along and so on. But he passed away, he still owned 5.2% of Titan, valued at $1.4 billion. I'm excluding all dividends. There were some pretty significant dividends over the years. So basically the 3.7 million became more than 1.4 billion. And if everything else had gone to zero after 2003 for him, he would still be $400 to 1.4 billion. It would still have been a tremendous record. And the amazing thing about Titan is that it's still firing on all cylinders. And it's actually, even today, in my opinion, still embryonic in its growth and development. It's a remarkable, amazing company. And it's been a great journey for Rakesh and his wife, who now looks after the portfolio. I'd be really surprised if she trimmed Titan. I think she probably understands it better than he did. And most of you are probably familiar with Nick Sleep. Nick Sleep's a good friend of mine, and he ran the Nomad partnership for about 13 years with his friend Case Zakaria. And when they shut down the fund in 2014, it had about $3 billion under management at the time. And I remember one of Nick's LPs calling me at that time in a very panicked mode. And this was a very large university endowment. And so they're saying, Nick is returning our money, and we don't want the money. We want him to keep running it. And I told them, I said, he told you what to do. He told you to take the money and just put it in 3 stocks equally: Amazon, Costco, and Berkshire. So now he's telling you that you don't need to pay me any fees anymore. And you just buy these 3 stocks, and you don't touch it for 10 years. So he says, yeah, but we can't do that. I said, why can't you do that? He says, we're not allowed to buy stocks. I said, change the mandate. But this is the way the world functions. They were so distressed, and they never bought these companies. And Amazon was, I think, about before the split, it was 1/15 of the price it is today. I mean, it was a radical change. And anyway, what Nick and Zach did for their own portfolio is they allocated a third each to these 3 companies. And then Amazon became 70% of his portfolio, which he was getting uncomfortable with. So he sold half to buy a digital retailer. You know, retail is terrible. It's not good. So ASOS has not done well. But I don't think Nick is suffering. You know, he's okay. And I met him, I think, last October. So he still has the 1/3 Amazon, which keeps going. And so that's worked out very well. So, you know, in 2004, they had put 20% of their portfolio into Amazon when they were running the fund. And a number of his investors exited at that time because they thought it was too concentrated. And they said, oh, we are very uncomfortable with this concentration, so they left the fund. Then later, when it became about 33% or something, even more left because they were very uncomfortable with the whole situation. But if everything else in his portfolio had gone to zero in 2004, they would have still beaten the S&P by 6 percentage points with just the 20% in Amazon alone. So Nick and Zach had many, many mistakes along the way. Many investments they made did not work, but it didn't matter. You know, in their case, you could have been wrong 80% of the time, and it didn't matter, and it still worked out very well. And it's really funny, just to go back. So Nick, you know, they still have their office in London, and they've given part of the office to some friends of theirs who basically, I think they run a commodities fund, which had not done well. And Nick was always telling them, can you just put like 5% of the fund in Amazon? And they said, we're not allowed to do that. And so they keep suffering, and that's the way the world works. And so then we have Ben Graham, and you know, Ben Graham's very famous for net investing and, you know, deep value and so on. But in 1948, he bought half of Geico, and he bought half of Geico for $712,000. And Ben's, you know, cornerstone of the Grahamian approach to investing was that you buy things well below liquidation value, and definitely well below intrinsic value. And as it gets when it starts approaching those valuations, you sell them, you know, and then you go back and find something else. He never applied that to Geico. He applied that to all his other stocks. He never applied it to Geico. And so when he passes away in 76, that 712,000 is 95 million excluding dividends. And he never wrote about it. So all the Ben Graham books never talk about the fact that the biggest success came from buying a great business. It did not come from all the, you know, great mathematical games of, you know, net investing and all of that. And the other thing is that he would be very diversified, but he put 25% of the portfolio into Geico. And basically, if everything else again had gone to zero, he would have still been done twice the S&P, you know, 12.9% versus 6.9%. And like I said, it's never been mentioned, you know. And when he passed away, it was more than half of his net worth. And then, you know, we look at this concept, the late 60s and early 70s, some of you may remember the Nifty 50. So the idea at that time was that there were these 50 great businesses, you know, blue chip companies in the US, and you would invest in all 50 of them, like 2% into each one, and valuations didn't matter. It didn't matter what price they were at. So these were like McDonald's and Coke and P&G and Polaroid and Xerox and all of these companies. And there is some controversy whether Walmart was part of the Nifty 50 or not part of the Nifty 50. So we'll consider both cases. If you consider the case that Walmart was part of the Nifty 50, Walmart went public in 1970, and you assume that Walmart is 2% of the Nifty 50 in 1970, and the other 98% goes to zero. You know, it just all of it, 98% error rate. You would have compounded at 13% versus 10.7 for the S&P. So with, you know, 98% error rate where they've gone to zero, where you only left with one stock which was 2%, you significantly beat the S&P, and basically just highlights how some of these amazing decisions can work out. Now, if we take the other case, which is that there's no Walmart in the Nifty 50. So in 1972, just before the great crash of 73, 74, these companies were trading at crazy numbers. Xerox was at 49 times trailing earnings. Avon was 65. Polaroid was 91 times trailing earnings. And, Xerox fell 71% in the next 2 years, and Avon fell 86%. Polaroid fell 91%. And eventually they all went to zero. They disappeared eventually. And the Nifty 50 as a group lost half its value in that 73, 74 period. And so if you look at these high flyers in 1972, you see really high PEs for like McDonald's and Disney and so on. But even if you bought the Nifty 50 in 1972 at those absolutely peak valuations without Walmart in the picture, from then till now is 10.2% annualized. It's just 0.1% a year below the S&P. So even with no price discipline, and even with a lot of zeros, and even with no outlier like Walmart, you almost go toe-to-toe with the S&P. And it still works out. But the reality is, when the Nifty 50 dropped 50% in 73, 74, by 1975, no one was in the Nifty 50. They had all moved on, badly bruised and so on. And again, staying with it would have still worked out quite well. And then we have the example of Coke. So in 1988, amazingly, Berkshire put a quarter of its book value into Coca-Cola, 25%, company they didn't control. And from 88 to 98, they had just a spectacular, 32% annualized return. And Coke in 98 was trading at a nosebleed valuation. It was trading like the Nifty 50 was. And in the meetings in 1999 and in 2000, Warren couldn't praise the company enough. There was such a great company. And then if you look at it from 98 till today, it's been just 4% a year. It's been positive, but it's just 4%. And actually it went through a long period of time where it was just flat and actually declined quite a bit. And Warren mentioned that in hindsight, he should have sold Coke in maybe the 99, 2000, because it was really difficult to justify that valuation. But even when you take the suboptimal decision of not selling Coke at this really high multiple, when we look at it over the entire period, we're still ahead of the index. It's 12% versus 10.5%. And this is one of the things that is a dilemma for me that I'm still trying to figure out, is basically what happened with whether the Coke decision to keep it or not keep it, which way is it better? So there's some key lessons that I've been able to figure out. The first key lesson is the error rate is going to be huge. So if we have Warren and Charlie having these big errors, mere mortals like us, we're just going to have a big error rate. The second is don't cut the flowers and don't water the weeds. And hold on. If it's a great business, hold on to it for dear life. The third lesson is do not pay fancy prices for great businesses. So if you look at all these examples of Titan and Coke and Amex and Geico and Amazon, Tencent, Ajit Jain and so on, Warren says about Ajit that every year when he pays him his bonus, he thinks he left a zero off. He said, between us girls, now that Ajit is part of the board and all of that, we get to look at his comp. And him and, I think last time I looked was like 20 odd million for him and Greg Abel. So, leaving the zero off, should be close to 200 million, but that's okay. Ajit is still happy. And then, we focus on the great businesses with great people and long runways. And actually last night, I had dinner with Chuck Akre, who's a wonderful guy. Chuck, some of you might have heard of Chuck. So Chuck lives in a town in Virginia called Middleburg, which has one traffic light. And I was really interested in seeing this one traffic light town. Because, when you hold these great businesses, you have nothing to do. So I wrote a letter to Chuck. I didn't know him, and I said, "Dear Chuck, I really want to see the one traffic light. And would it be okay for me to visit, and you can show me the traffic light," and so on. And amazingly, he responded. He said, "Yeah, we'll go take a look at the traffic light together." And I made a very nice trip to rural Virginia last I think, November. Great weather. It was a very nice drive. And so Chuck has this concept of the three-legged stool. And when I went to his office, there were a number of three-legged stools in the conference room. And so they've really made sure that they never forget about the three-legged stool. And the three-legged stool is usually used for milking cows. And one of the things, chairs should really not have four legs. If you don't want a chair to wobble, it needs to have three legs. So it was really stupid, whoever came up with the four-legged chair. And if you look at all the furniture that Frank Lloyd Wright created, the chairs are all three legs, and you don't have the wobbles. It's great. And so the three-legged stool that Chuck has is, number one, is he wants to invest in businesses which are run by people with the very highest integrity and who have skin in the game. So they've got an ownership in the business, and their integrity and abilities are unquestioned. So he doesn't ever want to compromise on the human aspect. The second is that it must have very high returns on equity, on invested capital, with an ability to reinvest at that high rate for a very long period of time. And so we want the great integrity, we want the high return on invested capital, and the third is a very long runway. And so he said that when we have these three elements, we're done, And so I was listening to a podcast the other day, and someone was talking to Chuck Akre, and he was telling Chuck Akre, so Chuck's number one position is American Tower. They've done extremely well with American Tower. It's a great business. And he tells Chuck, I found the next American Tower. And Chuck says to him, "Son, the next American Tower is American Tower." In a way that only Chuck could say it. So I'm not going to cut the flowers there. And so, compounding is the eighth wonder of the world, which Einstein tells us. And if you really look at, the magic of compounding, there are three elements that come in, right, when you're looking at compounding. Your starting capital, your annualized rate of return, and the length of the runway. And there's an interplay between these three factors. So for example, if I have a 7% return a year, applying the rule of 72, it'll take 10 years for my money to double. If I have a 10% rate of return, again applying the same rule of 72, it'll take 7 years. So basically you can switch and change one variable for the other. And so if you're interested in the final outcome being a really large number, it could be a really large number by starting with a large number and having a short runway and even a small annualized rate. Or it could be you start with a really small number and some kind of a rate of return and then the runway. So, whenever Warren is asked, some genie comes to you and offers you one wish, Warren, what would you like? And Warren's answer always is, I want it to be such that when I die and they look at my corpse, they say, man, he was old. And he doesn't want to live long because he likes to hang out with us. he wants to compound for as long as possible. So that runway needs to be as long as possible. And so Warren really understood. Warren was actually 56 years old when he became a billionaire. So if he had not given money away to the Gates Foundation, et cetera, it would be like 230 or 240 billion, be the wealthiest guy on the planet. So even when you look at the journey over the last 30 odd years for him, maybe 35 years, it's like 99% of his wealth has come in the last 3 decades. So the interplay is really important. And one of the things that we have the most control over, we have the most control over the length of the runway. When we invest, we may not be able to precisely tell how well the company does, but we have the runway for sure. So some other lessons, do not sell when things appear fully priced. So great businesses have a way to surprise on the upside. But when things are egregiously priced, selling may make sense. And when you figure out the difference between overpriced and egregiously overpriced, call me collect. So this is where it gets confusing. At what point do we flip from overpriced to egregiously overpriced? And a single great business, if we apply this math and methodology, could become 60%, 70%, even 99% of the portfolio, like we saw with Naspers. And I think Naspers had conviction because Tencent itself is very diversified in their income streams. And Berkshire, Buffett's had 99% of his wealth for a long time, itself is very diversified. But when we get to non-diversified companies, so when I started my fund, the very first investment I made, July 1st, 99, the first day of the fund, was Silicon Valley Bank. Some of you might have heard of it. Some obscure bank in California, And at the time, I was interested in Silicon Valley Bank because anytime they made a loan or they got a client, in Silicon Valley, if you're a masseuse at Google, you get stock options. Everybody gets stock options. Your server at the restaurant gets stock options. So when the bank would make a loan to their Silicon Valley clients, they will always get warrants. They would collect the interest, but they always get some warrants. And at that time in 99, they were sitting on this huge basket of warrants with no disclosure, except that we have a lot of warrants. And I realized that the bank was trading at that time slightly above book with no valuation given to all the warrants that they had. And all these companies at that time were going public. And so I was able to see that there's a bubble, but I was trying to find a way to play the bubble with upside with no downside. And I said Silicon Valley Bank is the perfect way to play this because it's not in the price. So if all those warrants are worthless, we still have a decent bank, or what we thought was a decent bank. And so about a year later, it had gone up like 150% because they started to monetize. And then in their quarterly earnings, what was happening is the monetization of the warrants was dwarfing their banking income. There was so much coming out. And in a moment of brilliance in 2000, I sold Silicon Valley Bank and said, well done, Mohnish. This worked exactly like you wanted. In a year, you more than doubled your money. And then I watched for the next 23 years, they compounded at 25% a year. Because actually it was a tremendous franchise. Even today, in many ways, it's a monopoly in terms of they're really good at understanding the needs of the tech business. But then, we come to the 23rd year and it goes to zero. So any number multiplied by zero is zero, no matter how big that number is. So this makes it really hard that, if I was very enlightened and I said, no, this is a great bank with a great franchise, and I had just kept it, there would have been very few warning signs. Some people saw it where their book value was upside down and so on and so forth, but maybe the answer there is you keep it to 50% or something. And then I have a real world situation, which is why we get to the core of the matter, why I'm here. The core of the matter is I need to learn, not teach, I need to learn. So one of my funds, the Pabrai Investment Fund 3, which is an offshore fund, has about 200 million in assets. There's a company in Turkey called Resas, which makes up 40% of this fund. I didn't invest 80 million in Resas. I invested single-digit millions in it. It just went up a lot. And there are two other bets that are about 30% together. So if we look at the fund, 70%, about 140 million out of the 200 million, is 3 bets, right? And Resas has already been a 10-bagger, but it's still cheap. It's not even fairly priced. It's actually probably today sitting at something like 1/3 of what its liquidation value is. And so if Resas went to its full liquidation value, it would be 250 million in the fund that today has a value of 200 million. And it would become like close to 70% of the pie. So I love the business. We see all these lessons. And what am I supposed to do? And I have no idea. I have no idea what I'm supposed to do. But these are happy problems. They're not sad problems, they're happy problems. And I'm hoping at some point I will get enlightened on some good answer on how this should be handled. So far, I don't have a very good answer, but we'll try to figure it out. And that's pretty much the song and dance. So thank you very much.